throw out an attaboy to you. When talking about teamwork, we think what you're doing actually is fantastic. It's a great way to stay connected, relevant, and the group just wanted to relay that to you. But that said, we thought
I'm trying to keep you relevant, Sean.
well, what we would really like you to do is maybe develop an app so that we can stay connected on that front. But
Yes.
it's serious, going back
I'd
to
like you to post this on that app, but go ahead.
the discussion we had around asset allocation, just touch on some of the key points. We do think the playbook has to change, and you know, we talked about sort of traditionally asset allocation work is built around a concept of reversion to mean and correlation of assets. And, you know, Andrew brought up a very poignant point that it doesn't take into account any evolution of the capital markets. And, you know, we're in an environment where, you know, things have changed dramatically. A long-term discount rate is 0. And as we're heading towards more of an MMT type of environment, the rules are breaking down. So the bottom line is you got to think about things a little bit differently. We touched on the whole sort of idea of, you know, the Morningstar style box approach, the whole growth value. We think it's just the wrong way to kind of look at things. That, you know, going back to you know, what was more prevalent back in the 70s, where you're really just investing in good businesses and companies. That's what's driving the investment decision, and not some of these other things. And that's the way it should be looked at. We talked about active passive. And again, as we have this transition, that's going to change the conversation around active passive because you're going to want to be more focused. I don't know if I heard a question coming, but, you know, those were the things. And bottom line, you know, when you're thinking, one of the big things that as an allocator we're struggling with is the interest rate environment we're working in and generating cash flow for the needs off of the portfolio. And you're going to have to just get more creative. It's clear that central banks are forcing risk taking. So you're going to have to find that comfort level of risk to take to generate whatever level of cash flow or income you're going to need off of the portfolio. And bottom line, there's a bunch of ways to do it. You're just going to have to get creative and match what's best for the purpose that you're doing it with. And then maybe to wrap up, talking about you know, some of the things that scare us. The election, not per se, it's sort of the outcome of what does that mean to regulatory and policy changes, and then how that flows through to the companies in your portfolio. You know, the one thing we did talk about, if there is a Biden win, probably going to mean a change in taxes, and you could see you know, some tax selling coming into year end, which in turn provides an opportunity too. So you're going to see some companies that are attractive that sell down. It's going to provide that opportunity because of that. So on one hand, there's a concern. On the other hand, it potentially creates an opportunity too. And if anybody else in the group wants to jump in, I'm sure I missed some stuff.
You actually got it all. Thanks, Sean. That was an impressive list.
So I mean, there's lots of, we'll make these slides available to you. In fact, this, you know, this whole thing is recorded and transcribed as long as you're on the app, because that's where it will be. I just thought this was also interesting. I would love to get the data behind how the U.S. manufacturing has now, you know, we fell behind, China fell behind, and we fell behind, and now we've surpassed China. I just don't know what those numbers are. I'm very curious to see how that breaks down.
Actually, Mark, that's just the relative index for that country. So it just shows that China went into it early and came out of it earlier. The U.S. went into it later and is coming out of it a little bit later, but we rebounded back. 50 is the number for expansion territory for PMIs, and they've moved back above 50, which is really the key point in a very short period of time. As I mentioned earlier, the real issue in the economy is more in the service sector rather than in the manufacturing sector right now. Because the service sector had created so many jobs over the last 30 years that coming back slower is going to be the problem for that. That's where that came from.
Interesting. Well, I'm actually, we're going to wrap up here. Erica Orange is their group is having a deep dive 4-hour session on what she'll do in an hour tomorrow. So we're starting early to please those in Asia and in some Middle East Europe, and not the West Coast clearly. But we'll have